So earlier we played a soundbite from our Jim Cramer just talking about the Dow hitting a new record. Dow actually outperforming the S&P and the NASDAQ over the last week, even the last month. This latest surge, part of 3M earnings, or due in part to 3M earnings and also Coca-Cola earnings. Do you think that should ease the concerns about overconcentration, high valuations, et cetera?
We do. Again, good morning, everybody. I mean, what drives long-term stock gains? I know this sounds like a broken record. It is earnings. And I know this earnings season's very early, but what have we seen, right? Most companies have done well. Obviously, the regional bank worries, and there's always some companies that disappoint, like you mentioned before I joined. But the reality is we're looking at record earnings this year. Record profit margins, continued strong guidance. I mean, I know that a lot of big companies still have to report, but the labor market is weak. Yes, we haven't had data in a while, but we know that. The reality, though, this is still a bull market. Still pretty optimistic, Frank. We're going to see a pretty good-sized fourth quarter rally when all is said and done, and just enjoy this strong earnings season. All
right, so Ryan, you're really focused on the bull market. You put out some research just recently. Yep. According to your research, since 1950, the average bull market takes about or lasts for about 8 years. You say that none of them have ever failed in the fourth year. Right now, we just celebrated the three-year anniversary, so we're technically in year 4. Does that mean, at least in the near term, you just see continued strength? You're not worried about tariffs, inflation, the Fed not cutting, potentially impacting the markets?
Well, we always have worries, right? We do get paid to worry, but I think it's important to know that what that study was, once you get to the third birthday, right, they continue to go, like an average of 8 years, right? The shortest was 5 years. So again, just because this bull market feels old, Frank, that doesn't mean it has to end. You know, I think the VIX has given us a really interesting signal. The VIX on Friday was up around 29, yet the S&P 500 closed like 1% from an all-time high. We'll keep this real simple, Frank. The only 2 times I've seen, I went back and looked at that with high volatility and a strong market, December of 98 and October of 2020. Think about those 2 times. Those weren't the worst 2 times to be considering long equities for well over at least a year. I know you hear late 98 and you think certain things, but the reality was it was still a strong market. So I think the VIX, I hate to say all clear, but that 10-point drop we saw on the VIX in 2 days, look in history again, that's kind of an all clear. And again, yes, November's strong, December's fairly strong. You know, It still is pretty good to us here.
All right, so Ryan, you're incredibly optimistic, obviously, about this bull market, but even you admit there's some cracks out there. Regional banks is one area you're looking at, housing's one area. What shores up those cracks, if you will, in your mind to continue this bull market to go? Because lending concerns could certainly be a speed bump, a landmine, whatever phrase you want to use.
No, you're right. I mean, there's always cracks under the surface, you know, potentially, but are they cracks or are they just something you don't necessarily have to worry about? We'd say that. I mean, one thing that just happened 2 days ago this week, the S&P 500's advanced decline line, how many stocks going up versus down, just hit an all-time high, right? Market breadth leads price. Look in history. Those advanced decline lines, Frank, usually peak and go lower, showing you there's some cracks under the surface. And you mentioned the lending stuff, right? Look at credit spreads. I mean, credit spreads still are not at all showing massive stress. Yes, some of these lendings and regional banks are clearly in some trouble, and that's what we've been seeing. Honestly, we saw high yield 2 weeks ago kind of weakening. We saw regional banks that have been lagging, so we're not minimizing it. Is it the first domino to fall? You know, we're not so sure about that. I think it's more company specific, and there's still more positive negatives out there.